Hi, I'm Jimmy. In this video, we're going to talk about recording a video where you're super suntan, but are also still wearing glasses. I apologize, guys. I spent the other day on the beach doing a bunch of research, not realizing sunscreen is a thing. That being said, on the day I happened to be on the beach, the stock market was down about 1,000 points. And as you might have seen some different headlines, kind of like this, talking about the fact that the stock market has had a pullback a decent amount where they talked about the Japanese yen, Japanese interest rates, US interest rates dropping, jobs data problems. And a lot of people were trying to come up with the reason the stock market was pulling back so much. So, in this video, I want to take a moment and explain the Japanese US carry trade. Doesn't have to be Japan, doesn't have to be the US, but basically, what is the carry trade and how could it really hurt the stock market as it has? But I figure if we all know how it works, perhaps we can find a way to profit from it. So to better understand why the carry trade even exists, well, it's important that we jump in and look at this chart. So this is a chart of the overnight rate in Japan, the Tokyo overnight rate. And the key line here for us to recognize is that the line in the middle is zero. We're talking 0%. In fact, for a long time, interest rates were negative in Japan. So for years, up until just recently, if you borrowed money in Japan, in theory, they paid you since the interest rate is negative. Well, recently there has been an increase in interest rates, but I would point out that increase is super minor. It was 10 basis points, so 0.1%, and they moved it up to 0.2 just last week when the stock market really started to tumble. With that kind of the baseline, with this is why the carry trade can happen. So let's imagine that we have an investor. And as you might have gathered, that investor is going to borrow money. Let's say for hypothetical sake, they're going to borrow 10 million yen. And from the chart we just saw, let's say this was about a year ago. Well, they're going to borrow that money. And let's just assume the interest rate is 0%. So they're borrowing 10 million yen at 0%, which means it's costing them nothing. Well, the very idea of a carry trade is that they're then going to take that money and they're going to find a place to invest. So they borrow money in Japan. They will then go forward and they will try to invest that money in something like, let's say, US Treasuries. A US Treasuries returning, give or take, about 5%. So let's say they're going to borrow at zero, invest it, get 5%. You could almost end the story there. That is how the carry trade is supposed to work. Borrow at zero, earn 5, pay back the loan, you keep the difference. And it's almost as simple as that. You would think, but it does get a bit more nuanced. But like many great investors, you and I can figure out a way to profit from that nuance. So here's how it works. We're going to buy US Treasuries. Well, in order to buy US Treasuries, we have to invest in US dollars. In order to invest in US dollars, we need a conversion rate. This is a chart of the US dollar to Japanese yen conversion rate going back the past 5 years. Now, like I said, in our hypothetical example, we're going to say that this trade started about a year ago. So we'll say about August 2023. Now, during that time period, if we were to narrow that down a little bit, during that time period, we're going to take the middle line there. We're going to say that the conversion rate was about 145. Now, what that means is it takes 145 yen to get $1. If it was 110 yen gets $1. That's what the chart is telling us. Now, as you can see on this 5-year chart, the trend for the US dollar to Japanese yen has been higher. Now, we were pretty fortunate in our hypothetical trade so far. Don't worry, I'll let the hypothetical example be somebody else once it starts blowing up. You and I are making good trades right now. Well, we're going to hold this trade for a period of time. And in a little bit, well, the chart moves up here and we can see that the conversion rate goes from 145 and we'll say to about 155. We'll jump into how that plays into it in a second. Okay, so now let's jump back to our example. So on our example here, we saw that we invested and we got 5% return in US Treasuries. So we took 10 million Japanese yen, we converted it at 145 to US Treasuries, and now we take our 5% return, and then we're going to return it back to Japanese yen, which is where the second currency conversion comes in. And we saw it went from 145 to 155 So with the conversion rate alone, we actually picked up an additional 7% return because the currency conversion rate went higher. Total, we end up with a profit of about 12%. Now, don't forget, this cost us nothing. Okay, so that brings us to how all of this begins to fall apart. Let's go back to this chart here of, let's call it the borrowing rate. And we can see that for a long time it was 0%, but now it's actually jumped up a little bit. Now that happened last week. They upped it from 10 to 20 basis points, which is how there is now a little bit of cost, assuming we're borrowing at this rate, a little bit of cost for our trade. So this trade went from being costing us nothing to now costing something. So when we jump back over to our example, well, what happens? The only difference now is we're still going to borrow the same 10 million yen, but now instead of 0%, now it's going to be 0.2%. So there's going to be a bit of cost to it. But just to keep the numbers as simple as possible, instead of returning 5% from US Treasuries, well, we're going to say that instead of returning 5, we in fact returned 4.8. We're just deducting the 0.2. Again, I'm oversimplifying the math, but I just want to illustrate how this works. Well, obviously that flows right through to the bottom line. Instead of getting 12, now we're getting 11.8, but nothing too dramatic. So now let's take a peek at how this could get real dramatic. Now, you and I are done trading because, we're the good traders. In fact, most of these trades, obviously, these trades were really happening. And most of these trades were done by big financial institutions. Think, big hedge funds, investment houses, things like that. Well, now those clowns here who are a bit too selfish, and if they were smart, what they would have done is they would have hedged their currency risk, which is the proper way to place that trade, by the way. If they were going to have done it, they should have hedged it. But these guys didn't. These guys are clowns. And they initiated their trade at about 160. But then they got real unlucky when the currency started to drop. So they initiated their trade when the currency conversion rate was at 160. Now it's at 145. So when we jump back to our example, well, they still returned the same 4.8%, still cost them 0.2. Fine, no big deal. But the currency change is where they get hit. Now, instead of gaining 7%, now they in fact lose about 9.5%. And clearly, that flows right through to the bottom line. And now their overall trade is down. But again, I want to point out the fact that they didn't put up any money to begin with. So that 10 million yen is a loan. They have to pay that back. This isn't a stock investment that they made that pulled back and they can kind of wait for it to play itself out. They've got to pay that loan back. So this is very quickly becoming a big deal. Okay, now you may be saying to yourself, I get how the trade fell apart, but how does that impact the entire stock market? So back on our hypothetical example here, in fact, let's roll back to the very first trade that we initially made. Now, don't forget, these are big money investors, big hedge funds, big investment houses, investors that live and die by their performance being better than average. So oftentimes, these types of investors can take unnecessary risks. So with this example, they borrowed $10 million. But if it's not costing you anything, why borrow $10 million? Why would these guys borrow 10 when they could borrow $100 million? And instead of going after a safe investment like US Treasuries and get 5%, well, why not instead push that and maybe buy some stocks instead? And now we're going after 10%. Of course, if we do that, we're getting 17% returns, assuming it all plays out. So clearly, this is fantastic performance. And you can bet that these big money investors, these hedge funds are out there promoting how good they did in their performance. Because don't forget, this performance is on money that they didn't even have. It wasn't even their money. That money that they have is still invested in their own fund, in their own stocks. They're definitely calling all their customers, bragging about how well they're doing with the customer's money. That is until everything starts to flip around. And the 10% gain that they thought they had or that they were expecting to have, well, over the past month, that eroded quickly. In fact, that 10% gain turned into a 10% loss. And the currency conversion rate, well, we already saw the chart of how that played out. What they thought, what they were hoping for would be a 7% or so gain. Well, that ended up being about a 9% loss when the pullback began to happen. And just like that, these guys end up a bit short of 20% in the hole. Now, again, I can't properly iterate enough how important it is to remember this is not an investment that they're down 19% on. They're down 19%, yes, but they have to sell all their stocks that they bought with this money. The 100 million yen that they borrowed and bought stocks with, they sell them. That certainly doesn't help the global stock market. But then when they convert it all back to Japanese yen and they have to pay back the money, they don't have it. So they have to start selling their core investments. Again, triggering more selling in the stock market, causing bigger and bigger problems. But the thing is that if we wonder how this could be such a massive problem across the board, it's basically comes down to the greed of these types of investors. Now, as you and I both know, these types of investors are going to go big. So instead of investing 100 million yen, instead of borrowing 100 million yen and investing that, well, these guys tend to be fairly, let's call it confident, overly confident. So why borrow 100 million yen, which is only about $600,000, depending on the conversion rate. So it actually doesn't have a meaningful impact on their portfolio until the numbers get bigger. Well, instead of let's say 100 million yen, why not go to 1 billion yen? Why not go to 5 billion yen, 10 billion yen? Where does it stop? Don't forget, the estimates out there that I've seen are as high as $1 trillion in this type of trade. And if that's true, that's $1 trillion that has to pull out of investments because this could get hurt, because the overall portfolio is going to get cracked when this happens. Now, let's assume that these guys are a little bit greedy, and probably a safe bet. If they are a little bit greedy, well, what about the stocks? Instead of investing in the S&P 500, if you're going to invest and you want to have a semi-safe investment, a diversified portfolio like the S&P 500 has proven to return about 9 or 10% a year. Well, what if they went after individual names, trying to, again, juice up the returns? Well, that could cause some companies to really get cracked. Well, we know that these guys didn't hedge when it comes to the currency risk, because a good investor who's trying to get involved in this type of trade, which is, by the way, a very smart trade if you do it correctly. I bet you if a guy like Warren Buffett did this trade, he would have hedged the currency risk, stayed with US treasuries, and been happy to pick up the 2 or 3% after hedging costs as gravy. Well, without these guys hedging the currency risk, who knows how far the currency could end up falling. If the Japanese are going to continue to increase interest rates, and it looks like they are. They started it when this carry trade really started hitting the news, and the US is going to decrease interest rates, which again, it looks like it is. Well, if that's going to happen, this trade goes bad real fast for all these investors that are still in it. So this could ultimately be a massive problem, I believe bigger than it already has been up to this point. But I think a lot of the impact of this can be avoided by, again, using these types of pullbacks in the stock market. The types of pullbacks, if you're seeing 1,000-point down day, I truly believe there's opportunities there. We just got to find good investments, good value investments, buy good businesses at good prices, which is what Warren Buffett always says. Now, if you need a bit of help trying to value individual companies, like I mentioned at the start of the video, I will leave a link in the description below for how to get access to the website, where we try to make it easier and quicker to value companies using all different valuation methods. So again, link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.